Our analysis of liquidity reveals a significant and alarming trend. The company's current ratio deteriorated from a healthy 2.33 in 2022 to a concerning 1.17 in 2024. More critically, the quick ratio, which excludes inventory, fell below 1.0 to just 0.77. When compared to the industry average, a current ratio of 2.2 and a quick ratio of 1.4, Aurora Prime is severely underperforming. A quick ratio below the 1 indicates that the company cannot cover its immediate debts without selling inventory, signaling a potential liquidity crisis and a heavy reliance on its inventory, which may not be easily liquidated. Moving to efficiency, the picture is mixed. On a positive note, the inventory turnover ratio improved from 2.0 to 2.48, suggesting a better management and faster selling of stock. However, this is overshadowed by a critical weakness in receivables management. The average collection period is 150 days, which is slower than the 105-day industry average. This means cash is trapped with customers for too long, straining the company's cash flow and contributing to the liquidity issues we just discussed. Finally, looking at overall asset use, the total asset turnover ratio remained low, around 0.5 in 2022, 0.52 in 2023, and 0.47 in 2024. This is significantly lower than the industry average of 0.567. This indicates that Aurora Prime is not generating enough sales revenue from its asset base, suggesting that some assets may be idle or underutilized.
The formula for debt ratio is total liabilities divided by total assets. To calculate it for 2022, 2600 divided by 5000 equals 52%. This means 52% of the company's assets were financed by debt. For 2023, dividing 3750 by 5180 gives us about approximately 53%. The debt ratio increased slightly from the previous year. Dividing 3560 by 5500, we get 65%. We can see a more significant increase in the debt ratio in 2024. The formula for times interest earned ratio is EBIT divided by interest expense. To calculate it for 2022, 300 divided by 60 equals 5%. This means the company's earnings before interest and taxes were 5% greater than its interest expense. For 2023, dividing 320 by 65 gives us approximately 4.92%, a slightly decrease from the previous year. For 2024, dividing 190 by 80, we get 2.38%. We can see a more significant decrease in it in 2024. The formula for net profit margin is net income divided by revenue multiplied 100. To calculate it for 2022, 180 divided by 2500 multiplied 100 equals 7.20%. This means the company earns 7.20% of profit for every ringgit of revenue. For 2023, dividing 191.3 by 2700 multiplied 100 equals 7.09%. The net profit margin decreased slightly from the previous year. For 2024, dividing 82.5 by 2600 multiplied 100 equals 31.7%. We can see more significant increase in it in 2024. The formula for return of assets is net income divided by total assets multiplied 100. To calculate it for 2022, 180 divided by 5000 multiplied 100 equals 3.60%. This means that the company generated 3.60% of profit for every ringgit of assets. For 2023, dividing 191.3 by 5180 multiplied 100 equals 3.69%. The RA increased slightly from the previous year. For 2024, dividing 82.5 by 5500 multiplied 100 equals 1.50%. We can see a more significant decrease in ROA in 2024. The formula for return of equity is net income divided by total equity multiplied 100. To calculate for 2022, 180 divided by 2400 multiplied 100 equals 7.50%. This means the company generated 7.50% of profit for every ringgit of equity. For 2023, dividing 191.3 by 2430 multiplied 100 equals 7.87%. It's slightly increased from the previous year. For 2024, dividing 82.5 by 1940 multiplied 100 equals 4.25%. We can see a more significant decrease in it in 2000. To start, let's evaluate the cash flow. The company consistently generates cash from its operation, reducing reliance on borrowing. This shows effective spending and the ability to meet short-term obligations, which is a sign of healthy financial management. In asset management, the company is improving of how it uses assets to generate sales, boosting production efficiency. This efficient asset management is crucial for increasing profitability and competitiveness. In debt management, the company has slightly reduced its reliance on debt, using more internal funds. This indicates sound financial management and reduced financial risk. Overall, the company shows improvement in cash flow, asset use, and debt management since these positive trends suggest a solid and sustainable financial future. In a nutshell, the company demonstrates a strong financial performance across key areas.
Based on this analysis, we propose 3 interconnected initiatives to steer the company toward recovery. First, aggressive working capital management. The company must enforce stricter credit policies and actively collect receivables to reduce the 150-day collection period. This will unlock cash, reduce the need for short-term debt, and directly improve the critical quick ratio. Second, capital structure and cost optimization. The alarming short-term debt should be refinanced into long-term debt to ease liquidity pressure. Simultaneously, a rigorous cost control program is needed to address the rising costs that are hurting profitability. Third, strategic asset utilization. Management should identify and divest underutilized assets. The freed up capital should be reinvested into high-margin projects to boost revenue and finally improve the low total asset turnover. Following our historical analysis, we will now benchmark Aurora Prime Berhad's performance against the industry average for 2024. This comparison will highlight the company's competitive standing and pinpoint specific areas of weakness and strength. Let's begin with liquidity. Aurora Prime's current ratio of 1.17 falls significantly below the industry benchmark of 2.2. This indicates potential challenge in fulfilling its immediate financial commitments compared to its peers. Next, for the quick ratio, the company's ratio of 0.77 trails the industry average of 1.4. This suggests a concerning dependency on converting inventory to cash to settle short-term liabilities, highlighting a clear vulnerability in its liquidity position. Moving to financial strategy and efficiency, we see a mixed picture. On one hand, Aurora Prime's debt ratio of 65% is lower than the industry standard of 75.3%. This reflects a more conservative financing strategy with reduced financial risk. However, it could also point to a suboptimal use of leverage, meaning the company might be missing opportunities to use cheaper debt to fuel growth. This conservatism has not translated into operational excellence. The total asset turnover is significantly lower than the industry norm, signifying inefficiency in using its asset base to generate revenue and potentially pointing to idle assets. Furthermore, the average collection period of 150 days far exceeds the 105-day industry average. This lower conversion of receivables into cash directly points to weaknesses in credit management and collection process, which exacerbates the liquidity issues we discussed. In summary, Aurora Prime demonstrates clear weakness in both liquidity management and operational efficiency when measured against industry peers.
What happens to a company's net profit margin if net income increases but revenue doesn't change? We'll use the 2023 data as an example. The image shows a 30% increase in net income from 191.3 to 248.69, while revenue remains at 2700. Originally, the net profit margin for 2023 was 72%, formulated with 191.3 by 2700. Now, with the increased net income, the new net profit margin is 92%, formulated with 248.69 by 2700, which results to be higher than before. When net income rises while revenue stays constant, the net profit margin increases. This means the company is more efficiently converting its revenue into profit. It's a positive sign of financial management and improved profitability even without increased sales. So, a higher net income with the same revenue leads to a better net profit margin and improved profitability.